Hi, Tom Lydon here in Washington, D.C. at the Charles Schwab Institutional Conference, here with Kieran Kirawn, who's Senior Investment Strategist at ProShares. Great to see you, Kieran.
Great to be here, Tom.
So everyone's talking about the fixed income space. The Fed doesn't seem to be taking their foot off the gas as far as rising rates. What's the average advisor to do?
Yeah, that's right, Tom. Certainly equities get a lot of the media attention in this latest bout of volatility and fear of rates rising, but of course fixed income has a much more direct correlation to what's happening with respect to rates. And really 2018 has been a difficult environment for fixed income investors. If you look at just the bar cap ag, right, the broadest benchmark, you're down around 2% so far this year. Now there have been pockets of strength, notably say on the short side, but even corporate credit, right? Even investment grade corporate credit has been a difficult place to be invested in 2018, and you're seeing some red on statements this year.
Yeah, absolutely. So, and there's not a lot of optimism that these trends might change going into 2019. So you folks have developed some strategies to maybe offset some of the turbulence that we might see in a rising rate environment. Talk about that.
That's right. Well, at ProShares, we do consider ourselves to be the leader in hedged fixed income solutions. So what we offer are investment strategies that allow you to invest in either investment grade or high yield credit, earn an attractive level of income in this environment, but most importantly, hedge out the harmful effects that rising interest rates can have on your portfolios.
Yeah, how do you do that? Is it duration shortening?
That's right. So we give you access to credit, right, on one side of the portfolio, in the long bucket of our portfolio, and then on the short side, we neutralize interest rate exposure by shorting Treasury futures. So a very capital efficient process that gives you very precise and surgical exposure to either end of the corporate credit market, but do so without having any interest rate exposure, which has really been a winning trade so far this year.
Yeah, absolutely, and a lot of folks feel that treasuries are always safe. Well, they're always safe as long as you hold them to maturity. But if you don't, in a rising rate environment, we've also seen for certain periods of time in a growth phase, treasuries can get hurt where corporates and high yields can actually do okay.
That's right, yeah, the long end of the treasury curve this period has been suffering. Yeah, a little more strength on the short end, but that may not continue going forward. You need to have exposure, in our view, to corporate credit. People are afraid right now, right? Because if you're invested in corporate credit, especially of the investment grade variety, typically you're coming with about 8 years of duration, right? And that's not a very comfortable place for a lot of advisors. But with these rate hedge solutions, IGHG, for example, is our investment grade product, you can earn a 4% yield, right, and have zero duration, which again, we think is very attractive in this environment.
IGHG.
IGHG is our ticker.
Great, excellent. Kieran, as always, enjoyed seeing you.
Thank you, Tom. Great
Thank
to be
you.
here.